Ever wondered about the stock market? It's not as complicated as it may seem. Let's take a journey into this financial universe and simplify it. Think of the stock market as a bustling marketplace, but instead of buying and selling goods like fruits or clothes, people here trade in pieces of companies. These pieces are what we call stocks. Now imagine a company as a big pie. Each stock is like a slice of this pie. When you buy a stock, you're essentially buying a piece of the company's pie. This means you own a tiny fraction of that company and you have a stake in its future. But why would you want to own a piece of a company's pie? Well, as the company grows and profits, the value of your slice can increase too. So buying a stock is like buying a slice of a company's pie. Just as pizza prices fluctuate, so does the value of stocks. These movements in stock prices are what we call market fluctuations. Factors such as economic news, company performance, and even global events can cause the value of a stock to rise or fall. It's a bit like the ingredients of a pizza impacting the overall price. If the cost of tomatoes goes up, your favorite margarita might become a tad pricier. Now imagine you only owned shares in the company that grows these tomatoes. You'd be at the mercy of fluctuating tomato prices. This is where diversification comes in. By spreading your investments across different companies or sectors, say, the tomato growers, the cheese makers, and the dough kneaders, you're less likely to see your entire investment take a hit if one sector experiences a downturn. It's a bit like ordering a half-and-half pizza to cater to different tastes. Remember, diversification is key to managing risk. Investing is more of a marathon than a sprint. Picture yourself in a marathon, steadily moving forward, keeping your pace, focused on the finish line, but not rushing to get there. That's how you should approach investing. In the world of stocks, it's not about quick wins or instant gratification. It's about having a long-term perspective, a vision for the future. When you invest in a company's stock, you're essentially buying a slice of their future profits. But these profits don't materialize overnight. Companies need time to grow, innovate, and conquer markets. Think of an acorn growing into a mighty oak. That doesn't happen in a day, a week, or even a year. It takes time. Investing is similar. It's about planting seeds today, nurturing them, and patiently waiting for them to grow into sturdy financial oaks in the future. So remember, in the stock market race, speed isn't the key. It's endurance, foresight, and above all, patience. Patience is your greatest ally in the world of investing. Now, time to delve deeper into some key stock market concepts. First, let's talk dividends. Picture them as a piece of candy companies hand out to their shareholders. It's a way of saying thank you for investing in us. Dividends are usually paid out in cash, and they're a great way to earn a steady income from your investments. Next, the importance of researching companies before investing cannot be overstated. Think of it like reading a restaurant review before trying out the new pizza place. You wouldn't want to invest your hard-earned money in a company without knowing its financial health, future prospects, and the industry it operates in, would you? Now, onto market indexes. These are like the pulse of the stock market. Indexes like the S&P 500 track the performance of a group of stocks, giving you a snapshot of the market's overall health. They're a great tool to compare your investment performance against. Finally, let's unravel the concept of dollar-cost averaging. Imagine you're buying pizza slices every week, regardless of the price. Some weeks you get more slices for your money when the price is low, and other weeks you get fewer slices when the price is high. Over time, the average cost of your slices evens out. That's dollar-cost averaging in a nutshell, investing a fixed amount regularly, regardless of the stock price, to smooth out the impact of market fluctuations. Armed with these concepts, you're well on your way to becoming a savvy investor. Scene script: Stock market explained simply. Investing without a strategy is like setting off on a journey without a map. It's not enough to just jump in and start buying stocks. You need a plan. And that plan starts with setting clear, achievable investment goals. Ask yourself, what do you want to achieve with your investments? Are you saving for retirement, a new home, or your child's education? Or perhaps you're looking to generate a steady stream of income. Your goals will dictate the kind of stocks you invest in, the risks you're willing to take, and the timeline for your investments. Now let's talk about risk tolerance. Just like choosing the spice level for your pizza, it's important to understand how much risk you're comfortable with. Everyone's appetite for risk is different. Some people can stomach the ups and downs of the stock market, while others prefer a more steady, predictable return. Your risk tolerance will influence the types of stocks you choose and the allocation of your portfolio. Another key aspect of your investment strategy is dollar cost averaging. This is a technique where you invest a fixed amount of money at regular intervals, regardless of the stock price. This helps smooth out the effects of market fluctuations and reduces the risk of making a large investment at the wrong time. Finally, remember that investing is not a set-it-and-forget-it kind of deal. It's important to regularly review and adjust your investments as needed. Changes in the market, in your financial situation, or in your investment goals might mean that adjustments are necessary. Remember, a well-thought-out strategy is your roadmap to investment success. It's not about timing the market or picking the next hot stock. It's about having a plan, sticking to it, and making adjustments along the way as necessary. So get out there, set your goals, understand your risk tolerance, and start investing with a strategy in mind. A well-thought-out strategy is your roadmap to investment success. So, there you have it, the stock market made simple. We've journeyed together through the bustling marketplace where companies' pieces are bought and sold. We've learned that stocks are essentially slices of a company's pie, and when you buy a stock, you're buying a piece of that company. Just like pizza prices, stock values can fluctuate, moving up and down. That's where the importance of diversification comes in. By spreading your money across different stocks, you're reducing risk and ensuring not all your eggs are in one basket. We've also discussed that investing isn't a sprint to the finish line, but rather a marathon. It takes time for your investments to grow, and patience is indeed a virtue in the world of stock investing. We've delved into key stock market concepts like dividends, which are basically rewards that companies pay to their shareholders. We've also discovered the significance of researching companies and understanding market indexes like the S&P 500, which track stock performance. We've looked at the concept of dollar cost averaging, a strategy that involves investing fixed amounts regularly to smooth out market fluctuations. We've also emphasized the need to set clear, achievable investment goals and to understand your risk tolerance, just like choosing your pizza's spice level. And finally, we've discussed the importance of regularly reviewing and adjusting your investments. As with any journey, the path to financial freedom involves regular check-ins to ensure